It's September 1st, and it is the start of the long Labor Day weekend. Welcome, Scott Riley with the Market Update Desk and Mortgage One. Um, the BLS jobs report slash BS jobs report came out this morning. Wanted to take a little bit of time here, review the data on that, how that's affecting the market, what we're going to see this weekend, and also how we're going to look at next week. By the way, I've got my Turks and Caicos hat on today since it's beginning of what seems to be fall. Has me thinking about the warm weather in Turks and Caicos, my happy place. So let's look at the BLS report. So that came in, the business survey, which is the headline, came in jobs up 187,000. Now that was a little bit over estimates of 170,000. But yet this is the third month in a row that we've had sub 200,000 job growth. So we're seeing trend lines starting to show. Between this and the JOLTS report, definitely seeing a downward trend on job creation. This equals bond-friendly information. Now, the big news that came out is we had revisions for the last 2 months of minus 110,000 jobs. So what that means, June was overstated and July was overstated. So the real June number was plus 105. The real July number was plus 157. Now, those numbers, when they came out, really negatively affected the 10-year bond and mortgage-backed securities. Unfortunately, these revisions don't have the same effect when they get corrected as when they come out so much higher than expectations. The birth-death model, this is the one that's very suspect and volatile. That came in at plus 103,000. So the 3-month average of jobs is 150,000 per month. 6-month average is 194. The 12-month average is coming in at 257. To give you an idea, look at 2022, and we averaged 399,000 per month. This downward trend is definitely showing a pattern, and we're thinking that's probably going to continue as we move forward. Now, deeper within the report, we saw average hourly earnings go up 0.2% month over month. Now, this actually brought the year over year down from 4.4 to 4.3%. So we're seeing average hourly earnings start to subside. Average weekly hours actually increased slightly, 34.4 to 34.3. So what this did was increase the average weekly earnings 0.5%. And that brought us from 3.5% year over year to plus 4% year over year. Now, that was the business or headline survey. Let's look at the household survey. This is what the unemployment rate is derived from. So the unemployment rate, or what's called the U3 factor, increased from 3.5% to 3.8%. Now, this 3.8% is pretty close to the target that the Fed has for unemployment of 4%. So we're getting pretty darn close. So the effects of all the rate increases are starting to filter through the economy. So jobs in this household survey were plus 222,000. The total labor force participation grew by 736,000. So the participation rate went from 62.6 to 62.8%. It's a sign people are getting in the labor force. Savings are starting to dwindle. Also means more part-time jobs are being picked up because part-time employment rose by 221,000 jobs. Full-time decreased by 85,000. So that's a very interesting number. Now, another unemployment factor called the U6, which is underemployment, it's classified, grew from 6.7% to 7.1%. So we're seeing those cracks starting to come in the jobs market. A couple of the Fed governors came out in the last day or so. Bostic came out and said, looks like we're within the target range. We had another Fed governor from the Atlanta Fed saying, yeah, maybe we're not there yet. We need more constraint on the economy. Don't know where she's getting that data from. It's very interesting. Um, on the on the BLS report, one other number I wanted to review was duration time that people are taking unemployment. Less than 5 weeks, people on unemployment grew by 217,000. People that are on for 5 to 14 weeks grew by 179,000. And those 27 plus weeks unemployment grew by 132. So we're starting to see some more difficulty finding jobs. As this filters to the economy, I think we're going to start to see over the next week or so much better improvement on the 10-year bond and mortgage-backed securities. In fact, we started out very well today. We were up in mortgage-backed securities and down in yield on the 10-year bond, which would generally mean better mortgage rates. But within the last 45 minutes, we've seen that turn. Mortgage-backed securities are down 21 and 10 years up to 4.18, which is up 9 basis points. A lot of that has to do with a long Labor Day weekend. Kind of what I predicted. We'd probably see news that we would like that would generally be bond friendly, but the market's going to react a little bit negative because traders are going to see a long holiday and protect the downside of the investments. Over the weekend, the market update desk, we are all going to be working here, looking to get our borrowers pre-approved, get offers in, make phone calls to agents, helping our buyers get offers accepted. Unlike your bank or credit union, yep, I'm working all weekend. We're all here behind the scenes taking care of our clients. Give us a call. It's an awesome time to buy. When you look over the weekends of holidays, you have less competition. Less competition means a higher chance of getting your offer accepted. Give us a call, 616-293-2189. We look forward to helping you out. Have a great weekend.